Good evening. We are not going to wait for others to join us. They shall find us along the way. The last time we met, we were discussing on working capital management. We were discussing on working capital management. And if I remember, I'm not sure whether we discussed on how to manage inventory. Did we? Just to check, okay? Just check. Johannes.
Yes, sir. Yes, sir.
Did we discuss on how to manage inventory?
No, we didn't discuss.
Okay, fair enough. Okay, thank you, Johannes. Okay. Okay, fair enough. Then I think we can start off by discussing how to manage inventory. Okay, inventory management. Okay, that's going to be our next bit. Okay, inventory management. When it comes to the inventory management, okay, of course, the core thing is that we want to assess, okay, we would want to, okay, when it comes to inventory management, okay, the policy the company want to use when it comes to inventory management, okay, is about the cost minimization, okay, it's about cost minimization. So in case there is a proposal, the company want to come up with, then of course, definitely, we would expect, okay, that the policy the company should be adopting should be one that the total inventory cost, the company shall be incurring is at the minimum possible level, okay? So if, for example, the company would want to implement a new policy, if there's the company would want to implement a new policy, then of course you have to compare what was the cost before, okay? What was the total inventory cost before, okay? And what is the total cost after the company implement this policy? Is there a cost reduction, okay? If there's a cost reduction, then of course you may want to advise the company to go ahead and implement that new policy. Otherwise, the company should not implement the new policy. It's about the cost minimization. Okay. And you see that the total cost of inventory is made of three elements. Okay, total inventory cost is made of three components. We have, of course, the first being the purchase cost. Okay, we have first being the purchase cost. We have holding costs. And of course, we do have the ordering cost. Okay, we have the ordering cost. Okay, those are three components that do make up the inventory costs. Okay, generally, in case, for example, we do not have discount being given. Okay, the company is not giving discount to the supplier, to the customers. Then essentially, therefore, we can consider purchase cost as an irrelevant cost. Okay, because it does not matter what level of inventory we buy, the cost may be the same. Okay, therefore, we sometimes do ignore the purchase cost. Why? If there is no discount, the supplier is given. Okay, so here's a question. You'll be given a question by the examiner. Okay, you have to go through it, see as whether is there any discount that this supplier is giving to the company? Is there any discount the supplier is giving to the company? If there's no discount supplier is giving, then of course you may want to ignore the purchase cost when doing the calculation, when estimating the total relevant inventory cost. Okay, so the holding cost and the ordering cost become therefore the relevant part of the inventory cost. Okay, that is the case. Supplier is not giving discount. If supplier is giving you discount based on quantity, then you have to include. Okay, you have to include the purchase cost. Okay, so go through the question and see as whether the supplier is giving discounts, for example. Okay, how you see that? Okay, we see that essentially, okay, there's a one model, okay, that essentially will always be giving us, okay, will always be giving us the optimal, okay, the optimal size of the order that the company should be purchasing from the supplier, okay, the Eoq model, okay. So the Eoq model, okay, will be able, okay, will assist us, okay, in being able to ascertain, okay, at what level the company should be reordering its inventory at, okay, based on the Eoq model, okay. This is the Q proposed by the Eoq model, okay, has given us, okay, 2 annual demand cost per order with the holding cost per unit per year, okay. Don't forget the analysis again, you're going to be doing the analysis, okay, over one financial year, okay, over a period of one financial year, okay. Q is equal to 2 times annual demand cost per order. We divide the holding cost per unit per year, okay. Simple thing, as I just mentioned, okay, the optimal policy the company should be choosing will be should be the one, okay, where the cost is minimized, okay, should be the one where the total cost of inventory has been minimized, okay. Therefore, consider purchase cost, consider holding cost, and consider ordering cost. If no discount, then you can ignore this component, okay? If there's no discount the supplier is giving to the company, then you may want to ignore that component, okay? And the only relevant bit when it comes to make the decision will be the holding cost, okay? And B, the ordering cost, okay? Anyway, the purchase cost, okay? The purchase cost, of course, will be equal to the price per unit, okay? We multiply by the annual demand, okay? The holding cost, okay? The holding cost will be equal to the average inventory, okay? The average inventory queued by 2 times the holding cost per unit per year, okay? And the ordering cost, of course, will be equal to the number of orders per year, the number of orders per year, D divided by Q times the cost per order, and that gives the total ordering cost, okay? Simple as that, okay? And that's on the management of inventory, okay? So just to refresh, I think we can do a quick question, okay? There's a question here, let me share. There's a question from your question bank. There's a question from your question bank on a company called PKA company, okay? I know you have gone through it, but just to reinforce, okay, for this revision, okay, on the PKA company, okay, PKA company. So go for it, then we attempt together, okay? So more or less, I think, until this point, okay? So don't go beyond that, okay? Under the inventory management, okay? PKA company can help us out, okay? So go through it. So this example, okay, I think it's a good question that you can use, okay, for the sake of our revision here. You have a company whose current policy is to order 100,000 units, okay, when the inventory level falls to that 5,000 units, okay. So for this company, the current size of the order is 100,000 units. Okay, and they do this once the inventory level falls to that 5,000 units. Okay, forecast demand in the next 1 year is 625,000 units. The cost of making one order is 250 euros. The cost of holding 1 unit per year per unit per year is 0.5 over euro. Okay, so I think from there we can determine what was the current policy. Okay, don't forget in this example, supplier does not give discount, which implies therefore we can ignore, okay, the purchase cost when doing the analysis. We can ignore the purchase cost when doing the analysis. So what costs are the current policy? Okay, just maybe a quick one. Okay, so here therefore, let's say therefore the total relevant cost. Okay, total relevant inventory cost. Okay, for this case, will be made of, okay, holding cost plus ordering cost. Okay, holding cost plus ordering cost. So since this company has what we call the reorder level, okay, the reorder level is by the time the company makes a new order, okay, at the point, okay, let me use that term, at the point the company makes a new order, how many inventory are there, okay, remaining, okay, for this company, therefore, we'll be told that there are that 5,000 units remaining, okay, by the time this company do make a new order, okay. With imply therefore, you may want to make an assessment, okay, could there be some buffer inventory that this company has, okay. You may want to do the analysis. Okay, once you see some reorder level, then you may want to go a step further. Okay, because the company is making an order when they already have some inventory. What could it be? Could there be some buffer inventory this company is keeping? Do not forget, buffer inventory is not always equal to. Okay, is not always equal to the reorder level. Okay. They're not always equal the same, okay? Especially in case there's lead time, okay? What's lead time? By the time you make the order and the time you receive the order, okay, is just some time difference, okay? If there's some time difference, okay, there's a call the lead time, then most likely, not most likely, the order level is not equal to the buffer inventory, okay? But in just in case, okay, the reorder level, okay, we have called the instantaneous replenishment of the inventory. That once you make the order, you get them immediately, okay. Then of course, therefore, at that point in time, the reorder level is equal to the buffer inventory, okay. In our example here, just go back to the question back. In example here, we told that the orders are received 2 weeks after being placed with the supplier. So you get them 2 weeks later, okay? You get them 2 weeks later. Therefore, in that case, therefore, we may want to assess therefore what there is a buffer inventory if there is any. Okay. Now here, you may want to determine what's the consumption for those 2 weeks when you've made the order and you're yet to receive them. Okay, what do you consume? What's the consumption for those 2 weeks? Okay. Therefore, I'm just put here consumption during lead time. We call this consumption, okay, during lead time. Okay, be equal to, in a year, we consume, or this number sells 625 units, okay. We will do that in a year, we have 50 weeks, therefore divide by 50. The lead time here is 2 weeks, therefore the consumption for those 2 weeks, therefore we multiply by 2, okay. And you get how much, therefore, to be the consumption during the lead time. And we get 25,000. So therefore, within those 2 weeks when the company is waiting for supply to deliver, they have already consumed, they already sold 25,000 units. Do not forget, they did make the order when the inventory balance was that 5,000 units. Therefore, the buffer stock, okay, therefore the buffer stock for the company, they made the order, or the order level was at 5,000 units. Okay, they have consumed 25 already. So what is remaining? Okay, therefore, by the time they get a new order from supplier, they have a balance of 10,000 units remaining. Okay, and this is coming for the buffer stock of this company. Okay, as I mentioned, don't forget the buffer stock only affects the holding cost. Okay, it only affects the holding cost. Okay, the buffer stock only affects the holding cost, nothing else. Okay, it means for the company is keeping more inventory. Okay. Than maybe what they need. Okay, so the only bit that is going to be affected, okay, is on the holding cost. Nothing else is on the holding cost, not the purchase cost, not the ordering cost. but only on the holding cost. Okay, so get to know of that. Okay, and then now we know the buffer stock. Therefore, we can say therefore the total cost, total relevant cost. Okay, therefore is gain made of holding cost. The holding cost, we have two inventory. We have the buffer. Okay, 10,000 units. Okay. Don't get the buffer remains the same from January to December. So there's no average as per se, okay, or the average is the 10,000, okay, because it remains constant from January all the way to December, okay. So 10,000, okay. Then we also have the normal goods they're buying, okay. For this company, at the current policy, every time we make the order, they do buy 100,000 units, 100,000 units, okay. Therefore, the Q, okay, is 100,000 units, okay, for this company. But don't forget, it's going to increase, decrease as the company is consuming it. Okay, just to for us to graph it. Okay, just to help us understand. Okay, what's happening. This is being time. Okay, this being quantity. Okay, this is quantity units of goods that you're buying. You will tell that once you make the order. Okay, we do have the Q, the size of the order we're going to make. Okay, let me put it here. Okay, the size of the order, the Q here is equal to 100,000. Okay, is 100,000 units, the Q. Okay, okay, we made the order before. Okay, of course, we made the order. Okay, some few days before. Assume that we made the order. Let me call this in week 2. We received the order in week 4. Okay, and then the inventory goes back to the normal level. Okay, that's more or less it's going to be like. Okay, as you mentioned here, this buffer stock is 10,000 units. Okay, it remains constant for the entire year. That's why you can see I don't divide by 2. However, the Q here, the 100,000, they move from 100,000 all the way to in quote 0. Okay, so it's going to be sort of moving up and down. Okay, based on how the company is consuming, and that's why therefore you have 100,000 units. Okay, we divide by 2. Okay? The average. Okay, the highest 100,000, the lowest is 0. Okay, for those normal goods. Okay. Okay. Let's give it for the units the company shall be holding at any point in time. At any point in time, we multiply by the cost of holding unit, the cost of holding 1 unit per year, which is 0.5 euro. Plus, so this gives therefore the total holding cost plus the total ordering cost. In a year, how many orders does this company make? Okay, in a year they do buy 625,000 units. Okay, every time they make the order, they do buy the Q of 100,000 units. Okay, multiply the cost per order, which was equal to 250 euros, if I remember, which is equal to 250 euros. Okay, here it is, which is equal to 250 euros. Okay, therefore you multiply by the cost per order, which in this case is 250 euros. Okay, therefore multiply by 250 euros, and that will therefore give us therefore the cost under the current policy. Okay, the cost under the current policy, which is how much? Okay, we get a cost of that one, so they're in euros. Okay, so we get a cost equal to the 1,562.5. Okay, don't forget this is only the total relevant bit of it. Okay, because we have ignored the purchase cost. Okay, now the company, okay, does account for the cost of the current policy, the total relevant cost under the current policy. If we do implement the proposal, the company, so let me go to the requirements, sorry. Okay, so the company determine the saving. So there's a part of sign determine the saving that could be made using the Eoq. What is the company? This company was choose the Eoq. Okay, now we compare the cost before and cost after once the company implements the Eoq policy. Let's see. Okay, let's implement the Eoq policy. Okay, let's go back. Okay, of course, the EOQ policy, of course, the first bit is you get. So let me just call this EOQ policy. The first bit is we get the Q proposed by the EOQ policy. And the Q is equal to, as I mentioned, 2 annual demand cost per order divided holding cost per year. Okay, they're giving us, okay, Q will be equal to 2. The annual demand is 625,000 units, cost per order 250 euros, holding cost 0.5 euro. And the Q, therefore, will be how much in case the company was to use a EOQ policy? Okay, and this gives us 25,000 units. 25,000 units. That's the Q proposed by the EOQ policy. Okay, therefore we are going to be reducing from 100,000 units per order to 25,000 units per order. Okay, we have done that. Therefore, since now we know the Q, we know that all the other things remains constant. Okay, the holding cost remain the constant. Cost per order remain constant. Okay, therefore, don't forget the buffer stock. The buffer stock is not dependent on the policy you're using. Okay, the buffer inventory, the buffer stock is not dependent. Or it is independent. Okay, it is independent of the policy the company is using to make the orders. So if it was 25, what was the Q before? If the whole buffer stock here it was 10,000, it remains 10,000 irrespective of the ordering policy. Okay, so get note of that. Okay, so if it was 5,000, it remains 5,000 even after. Okay, so it remains at 10,000. Okay. So in this example, therefore, the buffer stock still remain at 10,000 units. Okay, even after the company do implement a new policy, the EOQ policy. Okay. Therefore, cost under the new policy will be equal to the buffer still remain at 10,000. The Q now is 25,000. Okay, divided by 2. We multiply the holding cost per unit 0.5 euro. The Q remain the same, 625,000 units. Okay. The Q now is 25,000 units, okay, and the cost remain at 250 euros. Give us how much? Let me repeat. The buffer inventory remain the same. It remain at 10,000 units, okay, irrespective of the policy the company is choosing, okay. So it is independent of the policy the company is using. And you get a cost of 17,500 euros. Okay, 17,500 euros. Okay. So now you can see, in case the company was to implement the EOQ policy, this will be the cost the company being carrying. Don't forget the purchase cost is irrelevant because it is equal. It is the same whether you choose policy A, policy B. Okay. However, the only difference is the holding cost and the ordering cost. Okay, and they account for the cost under the old policy. So, cost therefore, if seeing the new policy is better, the EOQ policy is better. So, what the saving? Okay. Therefore, the net saving, okay, the company will be making, it will be equal to the cost before that 562.5, okay, minus 17,500, okay, and this again give us 14. It's given us 14,062.5 euros. Okay, so the company adopt the new policy. Of course, the company should implement the new policy, the EOQ policy, since it yields an annual net saving of 14,063 euros. Okay, the company should adopt the new policy since it yields an annual net saving of 40,063 euros per year. Okay, do not forget, by the once you done the analysis, you always advise the company Okay, this applies to section C question. Okay, always have that in mind. Once you're done with the analysis, always give the advice. Okay. Question on inventory management. Question on inventory management. Okay, if there's no question, then I guess we can move to the next bit of working capital, which is on the receivable management. Okay, which is on the receivables management. Now, to us, the management of receivable, the same criteria is going to follow. The same objective do follow here is about cost minimization. Is about cost minimization. Okay. When it comes to the receivable, don't forget you have the one as a company who is giving your customers discounts. Okay, for example, okay, you're the one who is going to give your customer discount, or you have a policy. Okay, you want to assess whether should I, for example, increase the number of days. Okay, should I, for example, last year I used to give my customer 15 days. Okay, now I want to increase my sales, so I want to give my customer longer days. Okay, from 15 to let's say 30 days. Okay. What's the implication of the changes in the policy? Okay, what's going to be the benefit you receive from the policy, the increase in profit, for example. Okay, so quantify all the potential benefits the company shall be receiving once they implement the new policy. So you quantify all those benefits. Okay, try to see. Okay, to weigh the cost, having a cost benefit analysis. Okay, what was my cost before this policy? What was the cost of this policy? Okay, make a comparison. And of course, you do as a company as to whether the change is warranted. Okay, does it yield any incremental benefits to the company? Okay, that simply is on the management receivable. Okay. Yeah, don't forget we said sometimes you can have a case where the company may want to hire what we call a factor. Okay, may want to hire what we call a factor. Okay, and that part of company that should be the one that's going forward shall be managing. Okay, the company working receivables. Okay, is the one that's given the mandate. Okay, the power. Okay, of managing the company account receivable. Okay, and so when it comes to factoring, okay. You can have two cases, okay? One of them is called the non-recourse, okay, arrangement, okay? And you have called the recourse arrangement, okay? The non-recourse and you have called the recourse arrangement, or the different, okay? In the case where the company do take insurance against their bad debtors, okay? Sometimes you can have the factor. Now, this company, okay, may insure the company against any potential bad debtor, okay, or any potential debtor becoming a bad debtor. So in case the company takes insurance against the bad debt, in case the company takes insurance against those bad debts, okay, then this is called a non-recourse arrangement, okay. So the factor cannot come get a loan and tell the company, hey, some of your customer did become bad debtors, okay, refer us our money, okay. That can't happen, okay, because it was the company took the non-recourse arrangement, okay. It took insurance against its own bad debtors, okay. In the case of recourse, that doesn't happen, okay. The company continue bearing its own bad debts. Okay, the company continue bearing its own bad debts. Okay, so the factor doesn't assume those bad debt expense. Okay, in the case of the recourse arrangement. But of course, we see here the factor fee is a bit high. Okay, in the case of non-recourse, okay, in the case of non-recourse, the factor fee is high. Why? Because the company has taken insurance. Because the factor is insuring the company against the bad debtors. Okay. Which one is better? Of course, you have to do the analysis. Okay, we are better. Of course, you have to do the analysis. Okay, then you have called the invoice discounting. Now, this is going to be a case where the company either have an outright sale of those accounts receivable. Okay, the company sells. Okay, the accounts receivables. Okay, to most of the time it will be the factor actually. Okay, but now the company is outright sale of its accounts receivable. In short, is the company is like using the bad debtors. Okay, is using the company is using its debtors. Okay, to acquire financing. If anything, it's more of a financing arrangement. Okay, the invoice discounting. Okay, the company may have issues to obtain money. They may have issues regarding their liquidity. Okay, so what do they do? Okay, Okay, why don't we take some of our debtors, sell them off to a third party? Okay, a factor, a bank. Okay. And this is going to be provided. This in response, okay, you're going to be financed. Okay, by this factor. You're going to obtain money. You're going to improve our liquidity. Okay, by selling off our debtors. Okay, in most cases, okay, the bank, if the worth of the data is, let's say, 1 million, okay, of course the bank is not going to give you the entire 1 million. Okay? It's going to give, for example, 950,000, okay, 950,000. Since this is going to be a factor, then once they collect the money, once they do collect the money from the customer, okay, $1 million, okay, then of course they're going to take the entire 1 million, okay, and the difference of 50,000, okay, become therefore the return that this factor is going to be receiving, okay, for advancing new money, okay, for financing new money, okay, of course that's referred to as invoice discounting, okay. Okay, and that's on the account flow management. Question? Okay, if there's no question, I guess there's a question here. The same question, okay. I guess we can do part. There's a company called, there's a question here, okay, let me look for it, okay. There's a question here that was tested, and the examiner actually said that most students didn't get this question well. Yes, here it is. It's called an Eoq company, okay, from your question bank, okay. Then Eoq company from your question bank, okay. Okay, you can go through it, then we discuss together. And Eoq company, okay, to assist us to have to revise on the accounts payable in Eoq company. But then don't forget, I'm just trying to pick some question here. It's you, if anything, to direct me. Which question do you think is best for you? Okay, to understand as we revise, as we go along the way. Okay, so going forward, be the one to propose a question that we shall be doing. Okay, because it's a revision. Okay, there's nothing new. I'm teaching you here. Okay, so as going forward, don't forget, pick the question yourself. This question we did in class, this question that we did in the cut, this question that we did in the assignment, I never understood. Can we repeat it? Okay, this is your revision. It is your revision, not mine. Okay, so going forward, suggest the question. Okay, let not me be the one to suggest the question. Okay, because it is your revision. Don't forget. Okay, so go through this question. So this question is more towards also towards the inventory, okay? But this time out, the suppliers of the company are giving discounts, okay? Suppliers of the company are giving discounts to the suppliers of this company. The suppliers are giving discount to the company, okay? So you make an assessment as to whether is it worthwhile for the company to take up the discount from the supplier, okay? So I'll not go through part B because it's about the one you just done, okay? A case where you would want to say to evaluate as to whether the Eoq policy is better, okay? We have done part B, so let me know the part B, okay? Now part A is where more or less I think we can concentrate, okay? The question is evaluate whether the company should accept the early settlement discount offered by its supplier, okay? Now here you have discount, okay? And here, the discount, okay, the company has skill sale for 5 million per year, and on average settles accounts with its trade payables after 60 days, okay? So they do pay after 60 days, okay? When a supplier has offered the company an early settlement discount of 0.5% if they pay within 30 days, okay? So here being asked, why don't you pay us a bit earlier? And I'm going to give you 0.5 discounts, okay? If they do so, the cost of administration will increase by $0.5 thousand per year, okay? And the company do buy components worth 1.5 million from the supplier, okay? So it's simply a case of, do we take out the discount or not, okay? Do we take out the discount or not, okay? And here the discount is based on the number of days. The discount is based on the number of days. It's more towards a trade payable case, okay? It's more towards the trade payable case, okay? Okay, let's attempt it quickly, okay? Okay. Assume that this company takes a discount, okay? Let's make the assumption. What if we take the discount, okay? So this is a sued company, okay? Let's take the discount. So discount to be received. Don't forget the discount to be received is a benefit to the company, okay? The discount received. The supplier is going to give 0.5 discount, okay? In case you do pay within 30 days. Let's assume that you pay within 30 days, okay? Therefore, 0.5% of what you pay to supplier becomes a discount. So multiply by 1.5 million, okay? And a discount we see, therefore, will be equal to how many dollars? Shillings. Give us how much? With the discount we received. So 25,000. Okay, 2,500, 2,500, not 1,000, 2,500. Okay, 2,500. Account for the amount of discount the company shall be receiving if they were to take up the early settlement discount, 2,500. Okay. Now, for them to get the discount, they must pay within 30 days, okay? They must pay within 30 days. Okay, previously, they used to pay in the 60, okay? Now, let's take the discount, okay? So, therefore, we pay within 30 days. If the company pays within 30 days, okay? So, first of all, we need to assess, okay, how much money need to make an assessment. How much money will the supplier extend the company? Don't forget to search. Trade payable in itself is a financing to the company. Trade payable is a financing to the company. Okay. Which means, therefore, we may want to assess therefore how much money is the company receiving from the suppliers. What are the payables? Okay. At 6 days. Okay. Currently, they pay in the 60. Okay. Then the payable will be equal to 60 out of how many days in the year do we use? Let me just go back to the question. In an year, we're meant to use the 60. Okay, you're meant to use the 60 days in a year. Okay. So take a 60 out of the 60, we multiply by the amount of goods that we buy from the supplier. In this case, 1.5 million. Okay. If we take the discount, they are going to be paid in day 30, okay, in day 30, and the amount of money that you're going to be owing the suppliers at any point in time during the year will be 30 days, okay, out of the 60 times 1.5 million. Give us how much for the current, okay, current rate, it is the 60, and how much money therefore the supplier excess to us at any point in time throughout the year. One, two, sure, there should be one or two. Okay, let's give us 250,000. Okay, to give us 250,000. To give us 250,000. That's the amount of money that supplier do accept the company at any point in time. Which means therefore, if they implement the proposal from the supplier, okay, therefore they're going to pay the amount the suppliers the company will be owing the supplier is 125,000. Okay, I'm assuming it's just half of what that is. Okay. Which means therefore the reduction in the financing that the company received from the supplier is equal to, therefore we can say the reduction in the financing the company received from supplier is 125,000. Okay. And that's mean for the company, since this is the finance the company is to obtain from suppliers, this is the reduction, then someone else must step in and finance the company. Okay. And the person who is going to finance the company, let's see. The company is going to be financed by overdraft at a cost of 4% per year. Okay, therefore, the reduction must be taken up by the bank through overdraft financing at a cost of 4% per year. Therefore, the cost the company pays for the extra amount of money they shall be borrowing, okay, is 4% of the reduction. Therefore, finance cost or interest cost equal to you pay 4%, okay, and you borrow now 125,000, and the finance cost therefore is how much? Okay, to give us $5,000. Okay, to give us $5,000. Okay, now this is the cost company. Don't forget, this is the cost you're incurring as a company. Okay, there's a cost you're incurring as a company. That this is the interest you're paying for obtaining money from the company. Okay, from the bank. Okay, this was a benefit you are receiving for the use of for taking up the discount. Okay, now we compare this benefit versus this cost. Okay, we compare the benefit versus cost here. Okay. And of course, it seems that there's more benefit than cost. Okay, there is more benefit to be received than the cost. Okay, therefore, for the net saving, okay, therefore, the company, okay, if they take up the offer from the supplier, then they're going to be saving therefore 3,500 minus the cost 5,000, give therefore an annual net saving of 2,500. Therefore, should the company take up the offer? Of course, the company should take up the offer from this supplier, since there will be an annual net saving of $2,500 per year. Okay. I think that's marks more or less the head of a good question to close off on the inventory management. Okay. In the case here, in the case where the supplier is giving discount and the discount is based on the number of days. Okay. If the discount is based on quantity, then we just follow the old procedure, just followed above there. Okay. However, now this time around we do include purchase cost as part and parcel of the cost of the inventory. Okay. Clear? Let me look for a question, okay, that deals with receivable management, okay, a question that we can use to close off, okay, on the receivable management, okay. So give me 1 minute and look for a question that we can use for management of receivable. Okay, page 68 on ZXC. Let's see that question. Someone has proposed that question, page 68 on ZXC. Okay. Let me look at it. So ZXC company, page 68. Okay. See country. Yes, this is a good question actually. Yes, thank you for that. Page 68 on ZXC company. Okay, so go through it, then we attempt together. Page 68 on ZXC company. Okay, so you have a company here that would want to. So the company here that currently, okay, so more or less they want to alter their their policies regarding how they manage their credit sales, okay, with the name of trying to revamp their revenues, okay. But let's see whether it's going to be is it worthwhile, okay, for this company. There's a term, is it going to increase, is it going to have any positive impact on their revenues, on their profits, okay, on their, of course, is it going to result to more benefits than cost, okay. So that currently, this company has an income level of $30,000. $30 million, okay, dollars, okay, of which 80% are sales that are made on credit, okay. The profit margin is 10%, okay. The fierce competition, it has lost market shares in looking away to win back former customers and keep the loyalties of existing customers. The sales director pointed out that they may want to offer a 0.5% discount to the customer who pay within 30 days. Okay, if this is going to happen, if the company does give the 0.5 discount in case they pay within 30 days, okay, there's going to increase the sales on credit, not the total sales, but sales on credit, but sales on credit by 20%. Okay, let's see if the sale increase, if the credit sales increase by 20%, what's the profit the company shall make from them? Okay, that can be fast working. That can be a fast working. Let's get the profit from the sales increase. Okay, so this is ZXC company. Okay, let's see, is credit sales increase. Credit sales after will be equal to 120%. You know that it will be 20%. It will increase by 20%. Okay, actually, let me just do 20%. Okay, credit sales increase. Okay, let me just get on the increase. Okay, it will be 20%. Okay, don't forget that it was before. Okay, let me just put it off here. The sales before, okay, were 30 million, okay, and 80%, the sales were 30 million before, and 80% of them were sales on credit, okay. These were credit sales before, 80% of that million, okay. If we implement this policy, then this will increase by 20%, then we multiply by 20%, okay, to give us how much? To be the increase in credit sales. So this was credit sales for the company before 30 million, 80% of 30 million. They increased by 20%. Okay, to give us how much be the credit sales, the increase in credit sales after. I get 4.8 million, confirm, I get 4.8 million. Okay, yes, we get 4.8 million, therefore to be the increase in credit sales if the company implement this policy. And we told that 10% of sales of the company are profit. Therefore, profit increase, therefore we can say profit increase for this company will be equal to 10% times the sales increase, which is equal to 4.8 million, to give us an increase in profit of 80,000, okay, for 80,000. Now, this is a benefit to the company, okay, it's a benefit company, but at what cost? Okay, you're going to give your customers 0.5 discount. So let's get how much discount, therefore, have you given to your customers, therefore, okay, let's go back, okay. The credit customer of company take an average of 51 days to settle the invoice. Approximately 0.5% of the company cases have become bad debtors in the past. Okay. The finance director has advised company that offering an early discount of 0.5% discount within that this would increase the admin cost by that further by year cost. While 75% of the credit customer, while 25%. Sorry. Okay. Well, 25%. Right. Well, 25% of credit customers would likely take up the discount. So 25% of credit customers will take up the discount, okay? Therefore, the discount means, so we are going to give the 0.5% discount to 25% of credit customer, okay? Now let's get the discount, therefore. Let's get the discount cost or the discount you're going to give to a customer, okay? The discount to customers, okay? Discount cost, okay? You're going to give 0.5% discount, okay? And the customer who are going to take up the discount, okay, is 25%, okay? Don't forget the credit customer before. Let me think I can have that small work in here, okay? Credit customer or credit sales before, that is before the new policy, were 80%, okay, of 30 million, which gave us 24 million, okay? Therefore, before, the total credit sales of the company were 24 million, okay? Don't forget now, they did increase by 20%, okay? They did increase by 20%, okay? And the increase was 4.8, was by 4.8 million. To give us, therefore, a total sales after, okay, a total credit sales after of 28.8 million, okay? 28.8 million, all in case you want to show it, okay? And we want 20%, okay? 120% of 24 million to give us 28.8 million, okay? You're going to give discount to 25, the one who's going to take out the discount is 25% of the total credit sales. And these sales have increased by 20%, okay? Therefore, 120% of 24 million. Therefore, how much discount, therefore? Discount cost, how much discount, therefore, is the company going to give to this customer of the company? Okay, we get, okay, Johannes, check on maybe Watkins. I think it should be 108,000. Okay, so we get a discount of 108,000. Look, this is across the company. Okay, the company is going to give this discount to their customers. Okay, 108,000. So this is a cost the company will have to incur if they were to achieve that intended profit increase. Okay, let's go back to the question. The bar debtors, so there's something about the bar debtors of the company, the bar debtors of the company. We told that before, the bar debt of the company were equal to When is the bar debt before this company? Before the policy? Yes, here it is, okay. I got it, okay. The company, approximately 0.5% of the company credit sales, okay, have been bad debts before, okay. Let's see, okay. So what was the bad debt before, okay? 0.5% of credit sales. What was the bad debt after? It will fall to 0.5% of credit sales, okay? So it is decreasing, which means therefore it might be beneficial to the company. But let's see, okay, well, this decrease. We need to quantify this decrease in the bad debt, okay? Let's quantify it. So you know that the bad debt, okay? So bad debt expense. Okay, let me call this before. The proposal was 0.5% of credit sales, that is 24 million, to give us 120,000. So before, the total budget expense was equal to 0.5% of 24 million. Don't forget, because budget is only on the credit sales, okay? Now, after the proposal, it will be equal to 0.375% multiplied by the total credit sales, what we have here, 28.8 million. To give us how much be the budget after, the budget debt expense after. Okay, we get 108,000. Okay, we get 108,000. It implies therefore, in case we have to compare, okay, 108,000. Thank you. So in case therefore we simply compare, what was the cost, what was the expense before 120? What was the expense after? It's 108. Therefore you are saving money. Okay, you are saving. You are having your expense decreasing by how much? By 12,000. Okay, this is a benefit to the company. Okay, because this therefore is a positive benefit to the company. This is a positive benefit to the company. Okay. Okay, let's go back to the question. Could find anything else. However, don't forget, you're going to give, for you as a company, you're going to give this discount for customer who pay within 30 days, okay? The customer who pay within 30 days, okay? Before, the credit customer company take an average of 51 days to settle the invoice, okay? If the company implements this proposal, advice for else 0.5 for the that decrease, admin caused by that 5 or 5% company will take advantage of discount. Okay. So in 5% of the customer will take advantage of the discount. Okay, that is they're going to pay within 30 days. Okay, they're going to pay within that days. What about for the 25%? When do they pay? Okay, just a minute. Okay, 10%. Okay, so the 25% pay within 30 days. Okay, the 25%, the remaining 25% will imply therefore they do not change their paying behavior. That's what it would mean. Okay, because 25%, okay, if they are to get the discount, they're going to get the discount. That means therefore they're going to pay in the 30. Okay, there were others. What do they do? They stick to their old payment policy. Okay, they stick to the old. They pay the company. They pay the company. They don't change their paying behavior. Okay, therefore on average, therefore they're going to pay. They're going to continue paying as usual. Okay, they're going to pay as usual. That they settle the invoice on day 51. Okay, they stick to day 51. Okay, that's so therefore the assumption you're going to make here. Okay. Now, does it imply the company is going to have less investment or more investment? Okay, let's try to work that out. Okay, what is the total receivables before and after? Okay, so currently, okay, then the next working could be on the receivable investment, the receivables investment. Okay, before the proposal, because this is before the proposal. Okay, the receivable investment of this company, okay, is equal to 51 days. So the customer take 51 days. Let me just go back. Okay. The customer take 51 days currently. Okay. They take 51 days out of 36 days. Okay. We multiply by the total sales on credit, which in this case is 24 million. So 51 days, 51 out of 360. Okay. Multiply by 24 million. Okay. We multiply by 24 million. Okay. So currently, what's the company total investment they make towards the account receivable? Okay, to give us 3.4 million. Okay, to give us 3.4 million. That currently, those customers, on average, the amount of money the company is investing. Okay, if you take on average, okay, at any point in time during the year, okay, the customers owes the company 3.4 million. The customer owes the company 3.4 million at any day. Okay, if you take the average, okay, the amount out of the company has exceeded to the customer is 3.4 million. What about after? Okay. This is after the proposal, okay? Don't we see that there are two customers here, the one who pay in the 30 and the one who stick to the old policy, they pay in the 51, okay? Therefore, the two combined, okay, on average, okay, how long do they therefore take to pay the company, okay? So let me guess here, average debtors day, average debtors day. There are two customers here. The one who pay in the 75, they who pay in the 30. There's 25% of them. Okay, they pay in the 30. The balance, that is 25%, they pay in the 51. Okay, therefore the two combined. Okay, how long do they take to pay the company? Okay, 25% pay in the 30. The balance 25%, we assume, okay, they don't change their paying behavior. It's an assumption I'm making. Okay, they still continue paying in the 51. Therefore, the two combined, how long will they take to pay the company? The two combined. Don't round off if possible. Okay, they take that 5.25 days. Okay, so they have the two combined. On average, they pay the company that 5.25 days. Okay, therefore, what's the implied investment the company should be making in this towards its customers? Okay, therefore, the receivable investment. Okay, therefore, the receivable investment will be equal to that 5.25 days. Okay, that 5.5 days out of the 60, we multiply by the sales made on credit after, which is 28.8 million. Therefore, how much money does the company invest in this towards their customer on average basis after they implement the proposal? The number of days out of the 60, we multiply by the total credit sales to give us to give us 2.82 million, 2.82 million. Okay, and therefore what will be the company investment in their customer? Okay, after they implement the proposal. As you can see, okay, it is decreasing. It was 3.4 million before. This amount of money the company used for exactly towards the customer, and this decreased to 2.82 million. Okay, is a decrease. So therefore, we are going to be investing less in our customer. Therefore, the decrease. Okay, therefore, this was decrease. This was reduction. Therefore, it will be equal to 3.4 million before. Okay, all the way to 2.82 million. To give us how much with the decrease? To give us 580, to give us 580, to give us 580. So since there is a decrease of 580, that's mean for the company, you're going to be borrowing less money. The assumption here you're making that someone is financing you, someone is giving you money, okay? But going forward, what do? You tell the person who's financing you, in the next 1 year, don't give me 580,000. Why? Because I'm investing less by 580,000 towards my customers. Therefore, I shall be saving the potential interest finance costs I could have been charged. Okay, and who's financing this company? Let's go back to the question. We see the person finance this company. Okay, this company is being financed by short-term. We've been told there's a short-term finance cost at 4% per year. So they're paying 4%, an interest cost of 4% per year. Therefore, going forward, they'll be saving 4% of the decrease. Okay, because again we borrowing less by 480,000. Okay, therefore the saving we multiply by 4%. Okay, therefore interest cost saving will be equal to 4% times 580,000. It's how much per year? Is equal to 23,000. Okay, 200. Look, this is a saving to the company. 23,200 is a saving to the company. Okay, I guess now we have all the costs, all the benefits. Okay, that we would require. Okay, I guess now we can quantify. I guess now we can have our final solution. Okay. Therefore, so this is our solution models. Okay, we have benefits, then costs. Okay, one of them, the first benefit is net profit. Okay, it's net profit increase, which we got. How much was it? We have done this working already. There will be increased profit of for 80,000. So for 8,000, Then of course we have just obtained interest saving, which is equal to 23,200. Then you have bad debt somewhere. I think we did this already. We have bad debt decrease. This is a benefit which we got somewhere. We got 12,000. Okay, we got 12,000. Okay, plus 12,000. That'll give you the total benefits. Okay, then you have expenses. Okay, cost. The first one is a discount you're going to give to your customer. Discount. The company is giving a total discount of how much? Here it is. Where is it? Discount cost. Here it is. 108,000. Discount cost of 108,000. So this is a cost, a cash outflow of 108,000 is a discount given to customer. Then we have admin cost. There's somewhere we've been told about admin cost. Let me just go to the question. The increase in admin cost of that 5,000. Okay, that 5,000. Okay, so this is a cost the company will be carrying. So less that 5,000. Okay, less. So admin cost. That 5,000. Okay, what's the net cost? Okay, the net saving. This should be more of net saving. Net saving. What's the net saving? Okay, we get 372,200. Okay, 372,200. Okay, positive. Therefore, what advice therefore do we give the company? Okay, the company should implement these proposed changes towards the account receivable. Okay, why? Because it's going to be yielding an annual net saving of 372,200. Okay, make it a habit to advise. Always make it a habit to advise. Once you learn the analysis, make it a habit to advise the company. Okay. So, question on the account receivable management. Okay, I think that was a good question, a comprehensive question that can help us in understanding on revising on the account receivable management. Okay. Don't forget, in case of a question, you can simply raise your hand up and mute yourself and you ask the question, or even you can use the chat. Okay, all those alternatives are available. Okay. Maybe lastly on working capital is on cash management. Okay, cash management. Okay, of course we have two models we normally use under cash management. Okay, we have the Baumol model. Okay, you have the Baumol model, and simply the Baumol model is simply like an EOQ. It's simply like the EOQ. Okay, if anything, it's referred to as a readaptation of the EOQ policy. Okay, is a readaptation of the EOQ policy. Okay, where the Q proposed by the Baumol model. Okay, the Q here. Okay. When it comes to cash, okay, is we want to determine, okay, if the company has excess cash, they should be investing that excess cash, okay, to earn profit, okay. If the company has cash deficiency, what do? Dispose of your previous investment you did make in the money market instrument, in the marketable securities, okay. Therefore, what's the Q, okay? What is the amount we should be investing, okay, at any point in time, in case we have excess cash? What should be the amount of, what's the value of the value of those marketable securities that should be disposed of, okay, in the case where we don't have enough cash? There's the Q, okay, is equal to, okay, 2, we multiply, in case as a company, you are able to generate excess cash. Therefore, in a year, what is the total excess cash you're able to generate, okay? Therefore, annual demand, we multiply by the cost per order. The EOQ was cost per order, divided by cost per year. In case you have to apply now this to the case of the Baumol model, okay, the Q, okay, will be equal to 2 annual demand. The cost per order, in this case, the transfer cost, or the cost per transaction, okay. We assume that someone is going to be investing this excess cash on behalf. How much they charge you for every transaction they make for you, okay? We divide by the holding cost per year, per unit, okay? Now, in the case of cash, what's the holding cost of cash? The interest foregone, okay? We divide by, therefore, by the interest foregone, okay? The amount of interest you have done, but since you didn't invest, you did hold that cash, what have you foregone? The interest, okay? And that simply is a Baumol model, okay? Therefore, in case the company has excess cash, invest at excess cash, okay, in the money market instrument. If you have cash deficiency, what do you do? Dispose of your previous investment from those money market instruments, okay? And that's on the Baumol model. The next model is called the Miller-Orr model, okay? We see that there, when it comes to the Miller-Orr model, okay, there are three things we need to know, okay? We have what referred to as the upper limit. We have the return point, that is the target cash. This is called the target cash balance, and this is the lower limit, the minimum, okay? The cash balance should always be equal to be not above the upper limit, okay? If they approach the upper limit, we reduce them back to the target cash balance, the return point. If they go below, okay, we ensure they don't go below the lower limit, okay? If they do that, then of course we need to correct the balance, the cash back to the return point, okay? So in this case, therefore, this company has excess cash. Therefore, the company needs to use that excess cash, okay, by investing. Therefore, here in this case, therefore, invest in money market instruments, okay. If the company has the cash balance goes towards the lower limits, okay, we need to increase the cash balance, okay, by disposing of, okay, this year by sale of, okay, money market instruments, okay. Simple as that, okay. The question is, how do you get this point, okay? The lower limit you get from the previous history of the company. You observe, as per the last maybe the 50 weeks of the year, what has been the minimum amount of cash the company has been able, for example, to generate or need, okay, within a given time frame, okay? You will get this from the historical data of the company, okay? The return point, okay, the return point on the head is equal to the lower limit, is equal to the lower limit, okay, plus a third of spread, okay. Then what's the upper limit, okay? The maximum cash the company should be having, okay, is given us the lower limit plus the spread, okay, plus the spread. How do you get the spread? The next question. The spread is given us, okay, 3 or 4 times the cost of transaction, okay, transaction cost, okay, times variance of cash flow, variance, not standard deviation, variance, okay, because the variance sometimes confuse you, okay, variance of cash flow, we divide by the interest, okay, we get the cube root, and that gives therefore what will be the spread. Don't cram these formulas. These are some of the formulas the exam is going to give you, okay. You just go to the formula sheet, you're going to get these formulas, so don't cram them, okay, don't cram them, but how to apply them in a case, okay. And that's the use of the Miller-Orr model, okay, as a cash management model. Lastly, but not the least, okay, we can also use what we call the use of cash budgeting as a tool to prepare to assist the company in cash management, okay, the use of cash budgeting. When it comes to use of cash focus or cash flow budgeting, okay, we simply do need to determine or forecast, okay, in the next 3 months, the next 6 months, okay, what is giving the total cash the company shall be making, okay, what's giving the total cash the company shall be making, okay. So we need to quantify all the cash inflows. We quantify all the cash inflows of the company for the next, let's say, 3 or so months, okay, maybe from sales, okay, from loans, okay, from customers, from what else? From issue of shares, okay, from the right issue shares, okay, quantify all the company income sources, cash sources, okay, you quantify all of them, okay, okay, that's your total cash inflow, okay, total cash inflow. Then also we quantify all the cash outflows of the company. So quantify all the cash outflows of the company for the next, okay, 3 months, for example, okay. Payment of salaries to the employees, payment of rent to the employee, to the landlords, okay, payment of interest on loans, okay, loan interest, okay? So quantify all of them, cash outflows, okay? Okay, cash outflows, okay? Rent, assume that you only pay on a quarterly basis, okay? So you only have to pay on the third month, okay? So now in here, you pay it in the third month. Interest you pay every month, for example, okay? So of course here we're going to have, okay, the total cash outflows, okay? So it'll be inflows, so there's the total inflows, there's the total cash inflows, minus the total cash outflows, okay? So here you have the net, okay? So net cash flows, okay? The sum of the inflows minus the outflows give us net for that particular month, okay? And of course, you bring forth the cash balance, okay? Cash balance brought forward, okay? This is for the month, okay? And the sum of cash inflows plus brought forward give us cash balance carried down, okay? And this is what we're again bring here, okay? To be the cash balance brought forward for the next month, okay? And we cover for again cash balance brought forward for the next month, okay? And that's how simply you do prepare the cash flow forecast. The main concern, okay, the main concern that you may have, okay, that you should be careful is the timing of cash flow, is the timing of the cash flow, okay? When does the cash come in, okay? Don't forget, do not use the accruals basis. Be very careful when preparing the cash flow forecast, the cash flow budget, okay? This cash budget, okay? We don't use the accruals basis. We use cash basis, okay? It's not when you're going to earn the money, okay? It's when you're going to receive that money, okay? It's not when you're going to make, it's not when you're going to incur the expense, but when you're going to actually pay the expense. So we prepare based on when the money gets out of the pocket, okay? That's when you're going to be reporting the particular transaction, okay? The money in, okay? It's when you're going to receive that money. That's when you're going to be recording it, okay? Cash basis, okay? That is what you have to be quite careful, okay? So moving on to working capital. And maybe before I forget, maybe the last thing, okay, could be the working capital financing policy. Okay, working capital financing policies. Okay, 3 of them: aggressive policy, conservative policy, okay, and you have matching policy. When it comes to working capital investment policy, there are also 3 of them: investment policy, 3 of them: aggressive, they're the same, the terms are the same: aggressive, conservative, and of course we have what we call the moderate policy. Okay, this can be 3 policies. Okay, financing, it's how do you finance working capital needs? How do you finance working capital needs? Okay, when it comes to aggressive financing policy, don't forget again, we financing using the more risky financing alternative. In this case, we finance most of the company working capital needs using short-term finance sources. Okay, when it comes to the conservative, you use the one that's less risky. In that case, therefore, we finance using the long-term finance sources. Okay, finance using long-term finance sources. Okay, matching policy, you finance the company permanent current assets using the long-term capital. Okay. In the case of the seasonal working capital, you finance using short-term. Okay, you finance using short-term. Okay, that's in case of the matching policy. Okay. When it comes to the investment policy, they're the same, 3 of them. Aggressive policy, here there's more towards risk taking, okay? Is more towards a scenario where the company is more towards, or the managers, okay, are going to have very minimal investment towards the working capital investment. They will invest very minimal money, okay? Minimal investment, okay? So they have very minimal investment towards inventory, very minimal investment towards receivable, very minimal investment towards cash, okay, and a high amount of money they borrow in quotes from their suppliers. So therefore the payable is be high value. Conservative is about they try to avoid risk. Okay, therefore they are going to have excess inventory investment to avoid stock at cost. They're going to have generous terms to their suppliers, to their customers. That implies therefore they have high investment they do make towards their receivable. Okay, and towards the supplier they pay on time. So which implies therefore they have quite low investment. Or low amount of money they do take from the supplier because they pay on time. They avoid as much as possible to avoid damaging the relationship between themselves and the suppliers. Okay. Moderate, okay, some inventory they may have excess. Okay, the receivable in the case of moderate, okay, they may have an excess inventory but also a minimal investment they do make towards the receivable. So a mix of the two. Okay, it will be a mix of the two policies that company do use. Okay. So sometimes the exam is going to ask you, discuss working capital financing policy, discuss the investment policy, discuss the difference between working capital financing policy and working capital investment policy. So be ready, just in case examiner would want to twist the question towards that angle. Okay. Any question towards working capital? Do not forget, there will be a question in the exam. Okay, that one you can't escape. Okay. There will be a question in the exam asking you about working capital, okay? And I normally suggest, if you look at the past exam reports by the examiner, now this has been an issue for the student for the past many years, okay? So get your hands on this particular topic, working capital management, okay? Because there will be a question either in section B, either in section C, but also some independent question in section A, okay? But most likely it will be a section B question or a section C question. That's a must. Okay, so I really hope that you guys, okay, you do get a good grip of this particular topic. There will be a question. Okay, of course, the highest concentration is more towards the inventory and the receivable. Receivable is more towards receivable and more towards the inventory. Okay, and as you see, section B question type of questions. Okay. Question on working capital management. So you're very comfortable in that particular area. Okay, it's my joy that you are comfortable, okay, on that particular area, because there will be a question. There will be a question in the exam, okay. The next topic, okay, the next topic is on the investment appraisal, okay, is on the investment appraisal. This is our next topic, okay, investment appraisal, okay. Now, I think we can take a short break, okay, then come back. Johannes.
Yes, sir.
We can take a short break.
Yes.
Okay, we meet at what time?
After 15 minutes.
Okay, so
It will
now
be around
okay, 7:05.
Yeah, 7:35.
Okay, fair enough. Then we can meet at 7:05. We discuss on investment appraisal. Okay, see you there.
Okay.
Okay, welcome back. So the other core topic, okay, is on the investment appraisal. It's on the investment appraisal. And I think that when it comes to the appraisal of investment or capital projects, okay, generally we do say that you can appraise using 5 different ways, okay, which you can classify them into category, okay. So we have the first category, okay, being the so-called the non-discounted, okay, cash flow technique, okay, the so-called the non-discounted cash flow technique, okay, non-discounted cash flow technique, okay, cash flow methods, okay, and you have the discounted cash flow method, okay, and you have the discounted cash flow method, okay. In the case of the non-discounted cash flow techniques, okay, or methods, we have 2 methods, okay. We have the so-called the payback period, okay. We have payback period, okay. In the case of we also have the so-called the accounting rate of return, the accounting rate of return, the accounting rate of return, ARR, also referred to as return on capital employed, also referred to as return on capital employed. Return on capital employed, okay. In the case of the discounted cash flow techniques, okay, because you can use 3 methods, okay. We have the first being the net present value method, the net present value method, NPV. We have the so-called the internal rate of return, the IRR, the internal rate of return, IRR, and you have discounted payback period. Yeah, so-called discounted payback period. The 5 methods you can use when it comes to getting the value of a project. Okay, payback period, the accounting rate of return, NPV, internal rate of return, and the discounted payback period. Okay, the 5 methods that you can use. Okay, the best way for me to explain this method is by doing an example. Okay, that's the best way. So last week, explain this method is by using an example. Okay, so let me get an example. We apply these methods. Okay, so I can get one example we can use that can be good for us. Okay. So here's a question. Okay, this question: PV company on page 11, page 12. PV company, page 11, page 12. Okay, so take 2 minutes to go through it. Then we discuss PV company, page 11, page 12. Okay, it's asking us to get the NPV. Okay, NPV, IRR, and the payback period. Okay, that's why I wanted this question. Okay, so PV company, page 11, page 12. Okay, so go through it. Then we discuss together. PV company, page 11, page 12. So take a minute to go through it. Okay, Dog, this is a type C question. Okay, this is a section C type of question. Okay, so let's do it. Okay, I'm first going to do it through the Excel. Okay, let me see whether I can go to get the platform which you're going to use, of course, in the main exam. Let me see whether I can go to get it. So give me a second. okay, in the same Excel, okay, but just for the sake of us doing to it, okay, on that platform. Let me try to look for it. Okay, so I need to go to the platform itself. Okay, no difference with Excel, only that, as we mentioned, don't get, you won't be having the toolbars on top there. Okay, so let me get one here, can help us out. Okay, so I want to use this Excel. Okay, I hope you can see it clearly from your side. So I just want to use this Excel. Okay, so in the question, okay, let me go back to the question. Between you're meant to get the NPV, you're meant to get the IRR, you're meant to get the payback, and you're meant to get the return on capital employed. Okay, so you do that. The selling price is $20 per unit. Okay, it is $20 per unit. That's the selling price. It is in current price terms. Okay, that imply therefore these are values at year zero. Okay, that imply therefore in case you want to get year one price, then of course we need to grow it, we need to increase it by the rate of inflation of 3% per year. Okay, I think that's can be our first working. Okay, we need to get therefore the selling price. Okay, so let me go back to the Excel file. Okay, from the CB platform. Okay, so here I can have here to be the selling price. If you cannot see it clearly, let me know, okay? Because so let me have year one, year two, year three, and year four, okay? As I always say, don't forget, I normally prefer to have markings going horizontally, okay? And because it makes it easy for my, when it comes to picking up the working catalog, okay? So instead of have them, it's much better to have them going horizontally as opposed to them being vertical. By what I mean, year one, year two, year three, okay, year four. Okay, I don't prefer them to be like this. Okay, I don't prefer them to be like this. I prefer them to be going horizontally. Okay, I think I've mentioned this in the previous classes, but in a way. Okay, therefore the selling price for year one, if you do that currently, that current price term, selling price is $20. Okay, and the price is increasing by 1.03. Okay, to the power of 1 because it's year one. Okay, it is increasing by 3% per year. Okay, 3% per year. Okay. And that's kind of for what will be the selling price we expect to be for year one. Okay. Now, since I have the formula, you can just simply drag the formula across those 4 years. Okay. So let me drag the formula across those 4 years. Okay. Getting the price for each of the year. Okay. And that's kind of for what will be the selling price for each of the year. Okay. So I have the formula here. So all I need is just to drag across. Okay. Don't forget this was the power of 1, okay, the power of B1, the power of B2, okay, to be automatic, the power of B3, as well as all the way to the B2, all the way to E1, okay. Okay, that's the selling price after inflation, okay. The next is to get the variable cost, okay, variable cost after inflation. So variable cost after inflation, okay. If we told that the variable cost today, okay, that is in current price term, okay, let me go back to the question. The be told is equal to $8. Okay, so here it is. Okay, so the current price. Okay, current price now. This the variable cost is equal to $8. Okay, the inflation will be told is equal to 4% per year. Okay, is 4% per year, both for variable cost as well as for the fixed cost. Is 4% per year. Okay, let me inflate therefore let me inflate therefore the value for variable cost. Okay, so let me go back to my platform. Therefore, it is 8. Okay, it is growing by the rate of inflation is 4% per year. Therefore, to the power of the power of 1. Okay, like therefore, what will be the variable cost for year 1? Okay, I can simply drag therefore from all the way from year 1 to year 4 to give me therefore what will be the variable cost for each of the year. Okay, Of course, therefore, variable cost, selling price minus variable cost gives the contribution. Okay, so this is contribution. Okay, contribution. Okay, therefore, the contribution per unit will be the selling price. Okay, minus variable cost. Okay, so that gives what will be the contribution per unit. Okay, 20.6 minus 8.3. 20.6 minus 8.3 to give me what to be the contribution per unit. Okay, therefore, to get the total contribution, I multiply by the number of units for year one. Okay, I multiply therefore by the number of units by for year one. Okay, therefore, in year one, how many units does this company sell? Okay, in year one, going back to the question, this company do sell 60,000 units. Okay, it sells 60,000 units. Okay, in year two, 70, year three, 120. Okay, year four, 45,000. So I multiply therefore the contribution per unit times the number of units. Okay, therefore in year one, 60, 70, 120, and 45. Okay, so here I multiply by 60,000 units. Okay, so multiply by 60,000 units. Okay, that therefore will give me therefore what will be the contribution for year one. I prefer to have my figures in thousands, so let me have my figures in thousands. Okay, let me change this to thousands. Okay, okay, I want to have the numbers in thousands. Okay, so I want to use the thousand separator. Okay, let me see. Okay, be careful. Okay, as you change those figures into thousands. Okay, because otherwise you're going to end up with a case where you have the figures in the figures, you end up freezing your entire cell. Okay, don't highlight the entire the entire worksheet. Okay, only highlight a given area within the worksheet. Otherwise, in case you highlight like we have done here, the entire cell, you may end up, the entire worksheet, you may end up freezing your computer. Okay, and of course, over the time is not going to freeze. Okay, to still be continuing to count. Okay, so be careful there. Okay, anyway, so I have the formula here in cell B4. Okay, since I have the formula here, I can drag it from year one all the way to year four, adjusting each year for the units I'm selling. Okay, in year two, this company is selling 70, so I adjust here to 70. Okay, year three, this company is selling how many units? It's selling 120, so adjust by 120. Okay, just the 5 figures here. Year three, it's selling 45,000, so adjust to 45,000. Okay, and that can therefore what to be the contribution for each of the year. Okay, what to be the contribution for each of the year. Okay, let me remove these dollars. Okay, okay, that's year one. Okay, and can therefore what to be the contribution for each of the year from year one to year four. Okay, don't forget, in case you don't want to allow me to pause, you let me know. If you have a question, you let me know. Okay, but again, what will be the contribution per unit for each of the year. Okay, next can be we get the fixed cost. Okay, we get the fixed cost. Okay, we do that currently the fixed cost is equal to 170,000. Okay, let me just refer back to the question. Currently the fixed cost per year is 170,000. Okay, so here it is. Currently it is 170,000 per year. Okay, this is going to be increasing by 4% per year. Okay, 4% per year. Therefore, let's inflate fixed cost by 4% per year. You look at 120,000. Okay. Yes, this one savings. As you can see, the reason why I normally want to have the separator is if you make a mistake, it comes easy to pinpoint. Okay, like now I can see that I've added an extra 0, so it comes easy to pinpoint where you may have made a mistake. Okay, and so this is 120,000. Okay, it is increasing. The rate of inflation is 4% also, so 1.04. Okay, 1.04. To the power of 1 to the power of year 1. Okay, so the power of year 1. Okay, that therefore give me for what will be the fixed cost for year 1. Okay, okay, I do this for the entire 4-year cycle. So I have the formula, so I simply drag it along the way. Okay, clear? Okay, let's go back to the question. Okay, how we know that there's no working that we need. Okay, fixed cost, we've done that. So no terminal value, okay, so no scrap value. Okay, so no terminal value. Therefore, no scrap value, no working capital, no tax. Wow, there's a very easy question. Anyway, okay. I think you're done with workings there. In case there's no tax, there's no scrap value, no working capital, then you're done with the question. Okay, let's go back to our Excel. Okay, so therefore, I think we can now prepare a final solution. Okay, so here, let me begin with year 0, year 1, year 2, year 3, year 4. Okay, let me change these two. They're not, these are years. So let me simply remove the years. So this is okay. Then you can have here contribution. Okay, I want to determine therefore what will be the cash flow for each of the year. So contribution, year 0, nothing. Year 1, I simply call my workings year. Okay, contribution from the previous workings year. Okay, I have it there. Okay, so it's in cell B4. Okay, and now since my workings were horizontally, okay, then I can be able to drag, okay, my formula and copy my workings on top there, okay, from year 1 all the way to year 4. Okay, don't forget, as I mentioned, this will not be possible. This will not be possible in case your working were going vertically. Okay, you could not have been able to copy them. Okay, if the workings were going vertically, and that's why I say that I prefer to have my workings going horizontally. Okay, so here minus less fixed cost. Okay, we raise the fixed cost. Okay, fixed cost is negative, so I need to put a negative. Okay, I'll call my workings here. Okay, don't forget fixed cost is negative. It's a cash outflow. Okay, so that's it for year 1. Then I can drag my formula all through. Okay. Okay. And since we don't have working capital, we don't have stock value, don't have taxes, that's the end. Okay. You have cash flow. Okay. So year 1 will be equal to sum of cash flows we have above there. Not actually, before we even do that, let's just include here initial cost. Okay, let me just include here initial cost. Initial cost. The initial cost of this investment is 2 million, so negative 2 million. So let me use 0, okay, because it's 2 million. That is the initial capital for this investment. Okay, nothing else. So we have here cash flows, which is equal to sum. Okay, from cell B8 all the way to cell B10. Okay, so I have it here. I have the formula here. Now I can drag it across or through. And by the way, be careful. In case here you did put a positive, if here the fixed costs are positive, then you cannot use the sum function. Okay, that's why I prefer cash inflow, they remain as positive, cash outflow, they remain as negative, so that I can use the sum function. Okay, so get as much as possible, you need to use the sum function as much as possible. Don't use a calculator. Okay, I normally say that it's better that you don't have calculator when doing CQC. But anyway, whatever method that is getting so for you, you can use it. But as much as possible, all your workings need to appear on this Excel. All your workings need to appear in this Excel. Okay. So and use the power of Excel. Use the power of Excel. Okay. If there's some workings that can do it through Excel, do them in that Excel. Don't try to use calculators. Okay. I prefer to do that. Okay. Okay. Anyway, now I have my cash flows. Okay, for year 1 or from year 0 all the way to year 4. Okay. What does the examiner want of me? NPV. The examiner wants me to get the NPV. Okay. Don't forget the NPV formula is already in this particular cell, in this Excel. Okay. In this work file, this worksheet you're given. So equals NPV. Okay. It's already there. Okay. Equals NPV. Okay. We discount at what rate? We discount at the cost of capital of this company. Was how much? Let me just go back. The cost of capital of this company is equal to 10%. Okay, the cost of capital is equal to 10%. So I discount those cash flows at 10%. So I discount them at 10%. So 0.1, 0.1, comma. then I define my cash flows from year one. Okay, this is NPV from year one. So I define my cash flows from year one, from cell C11 all the way to cell F11. Okay, so I define my cash flows from C11 to F11. Okay, you define the cash flows from year one. Okay, therefore to get the NPV, I subtract. Okay, I subtract the initial investment, which in this case was 2 million. Okay, I subtract the initial investment, which was 2 million, and that gives me therefore what is the NPV for this particular project. Okay, as easy as that. Okay, I enter, and that comes for the NPV positive. The risk 7,785. Advise the company should invest in this project since it has a positive NPV of risk 7,785. The next question was asking us to get IRR. Okay, so to get IRR. So equals IRR. Okay, for the case of the IRR, okay, you define from year 0. Okay, if you want to use this formula, you want to use a formula within the Excel. Okay, we define from year 0. Okay, not from year 1, but from year 0. Okay, if we define from B11, okay, all the way to cell F11. Don't forget, this will only happen in case if year 0 is a negative. If the cash flow in year 0 is going to be negative, that's you can see I did put a negative here. Okay, negative 2 million. Otherwise, in case this was a positive, then you can't be able to get the IRR. Okay, you can't be able to get therefore the IRR. Okay, and I enter. That's therefore, let me just let me change this to custom. So general. And if you want to get percent, I get that to be 18 or 30%, whatever you want to use. Okay, I get 18. Okay. Okay, I guess 13.99% to be the IRR for this particular project. Okay, simple as that. Okay, simple as that. Okay, for the IRR, you start from year 0. You define the cash flow from year 0. Don't forget, year 0 cash flow need to be negative. Okay, don't make that mistake. Okay, the year 0 cash flow need to be negative because it's a cash outflow. Okay, like they have just done here. Okay, next you're meant to get the return on capital employed. You meant to get return on capital employed. Okay, that's the next question you've been asked in this particular case. Okay, what do? Don't forget the return on capital employed. Okay, let me just remind you the formula. Okay, it's given us average investment. Okay, average profit. We divide by average investment. Okay, we divide by average investment. You don't need to use this formula in the exam. Okay, you express as a percent. You don't need to write this formula. Okay, don't waste time writing the formula. Okay, I won't write it because I want to show you. But the main exam, don't write this formula. Okay, go straight. Okay, get the average profit, get the average investment, then you simply divide them. Okay, so don't need to write the formulas. Okay, simply apply the formula in short. So we do need to get the average investment. Okay, investment. Okay, is given us. Okay, initial investment. I put brackets. Okay, initial cost. Is initial cost plus scrap value. Okay, divide by 2. Okay, don't waste time doing this the way I'm doing here. Okay, don't waste your time doing this. Okay, why? Because the examiner, okay, there's no need for you to the formula. There's no marks for the formula, by the way. Okay, so don't. It's about applying the formula. Okay, so these workings here, these two, don't do them. Okay, as much as possible. Okay, don't do them in the main exam. Okay, don't start writing down the formulas. Okay, it beats the logic. Either way, okay, so here the average investment will be equal to the initial cost was 2 million. Okay, so 2 million. So what thousands is 2 million. Okay, the scrap value is 0, so I can just let me just put it there. Okay, plus 0. No need for us to do it. Okay, divide by 2. Simply divide by 2. Okay, and we get 1 million to be the average investment. 2 million plus 0 divide by 2. And by the way, be very careful with the brackets. Okay, where do you put the brackets? Because I think the examiner in the math sitting did mention that students forget to put the brackets. Okay, they forget to put the brackets. Put the brackets where they're necessary. Okay, you need to put the bracket where they mean to be put. Okay. So next is to get the average profit. For this company. Don't get here, if we told that the company, okay, if I was to call the call, let me just go back to what means we have here on top, okay. Contribution minus fixed cost, what does this give that, okay? This gives therefore profit before depreciation and tax. They give us profit before depreciation and tax, okay. Contribution minus fixed cost give us profit before depreciation and tax. In this example, if we don't ignore tax, however, we do have depreciation. We do have depreciation, the loss of value of the asset. But in year 0, we bought the asset for 2 million. Okay. By the end of year 4, the value of the asset is 0. Therefore, within those years, the total loss of value of the asset, was how much? It was 2 million. Because its value in year 0 is 2 million. Its value in year 4 is 0. Okay, therefore the total value of the total depreciation therefore is equal to 2 million. Okay. And you can say that the average profit will be equal to, just put it here, okay, will be equal to total profit before depreciation, okay, sorry, before depreciation, okay, less depreciation, okay, less depreciation, okay, which in this case is 2 million, okay, which is 2 million. The profit, the total profit, okay, for the entire years, okay, a sum. And go back here, I have the profit already here, okay, so I want to get a sum, okay, sum of cash profit here, which is here. Yes, I have them here already, okay. Don't forget, profit is contribution minus fixed cost, okay. So I get the sum of all these cash flows here. All this in this here, therefore, they are profit, not cash flows as per se, okay. Yeah, the sum of those 4, okay. And I give the sum of the profit before depreciation and tax for entire 4 years, okay. Therefore, here I can call this to be total profit, okay. Sorry, this is going to be profit, therefore, okay. Is going to go to, okay, sum of, okay, be equal to the profit minus depreciation, okay, and again would be the profit for those 4 years, okay. Therefore, average profit, therefore, you can say therefore, okay, average profit okay, is equal to the sum what we have here. There's 1 million, we divide 4 years, the 4 years, so we divide by 4 years, okay, and every year we get therefore the average profit to be 250,000, okay. Therefore, return on capital employed, okay, return on capital employed. And by the way, label your works, okay. Don't just put a figure here without having what is that, okay. You need to label your work, okay. If this profit, like profit. If this depreciation, like depreciation, okay. Label your, don't confuse examiner, okay. Because if you confuse examiner, it's going to deny you marks. So don't label your work properly. Label your work properly, okay. So in this case, I want to get return on capital employed, which will be equal to the average profit here, divided by average investment, okay, which in this case was 1 million. And of course, I express this as a percent, okay. Let me express this as a percent, okay. And I get 25%, therefore, the return on capital employed. Return on capital employed is the return on capital employed, okay, 25%, okay. If I go back to the question, okay, the target return on capital employed was 30%. The target, okay, here was 30%. Therefore, should we invest? No, the company should not invest in the project since the return on capital employed 25% is less than the target return on capital employed of 30%. The company should not invest in the project based on the return on capital employed. And lastly, you meant to get the discounted payback period. Okay, you meant to get the discounted payback period. Okay, so let me share. Let me share my Excel again. Okay, I want to get the payback period. Okay, so here, okay, we can have here. Okay, can have here, and here can have cash flow, and here can have cumulative cash flow. Okay. Okay, this is discounted, so this is going to be discounted cash flows. Okay. Let me pick them. Actually, let me have them going horizontally, okay, so that I can able to pick my works. Okay, let me just have them horizontally. Yes, so I have these. Okay, I want to just have them going horizontally. Okay, can have year 1, year 2. Let me begin year 0. Year 0. Okay, year 1, 2, 3, and 4. Okay, to have those years. Okay, the cash flow for year 0. Okay, it's already here. It's already here. So let me just go back to where it is. Okay, it's the cash flow for year 0. Here it is. Okay. Okay, I can drag it across for all those 4 years. Yeah. Okay, so those are cash flows. Okay, for year 1 or the year 4. Okay, so that is, let me have them in present value. Okay, present value. Okay, present value of the cash flow. Okay, for this is already there's a cash flow. The formula, don't forget, it's simple to get the present value of an individual cash flow is cash flow. We divide by 1 plus r to the power of n. Okay, so therefore divide by 1.1, okay, to the power of, okay, the year is 0. Okay, that's kind of for what will be the present value of the cash flow. Okay, for year 1, for year 0, all the way until year 4. I want to get the present values because it is a discounted payback period. Okay, all the way until year 4. Okay, then here I can have cumulative cash flow. Cumulative cash flow. Okay, which will be equal to, okay, this is gain equal to, so okay, this just means as it is. Okay, I don't actually don't need this. Okay, so I can begin from year 1. Okay, which gain equal to the previous year cash flow. Okay, plus what has just been earned. Okay, that gives for the game me the cumulative cash flow. Okay, 2 million plus negative 2 million plus 509. Okay, that gives for the cumulative cash flow for year 1. I can do this until year 4. Okay, as you can see, therefore, by the end of year, sorry, just a minute. I think my formula seemed to have had issue there. Okay, because cumulative cash flow is the previous year cash flow. Okay, the equal to cash flow equal to the previous year's cash flow plus what has been earned. So plus what has just been earned. Yes, that it is. Okay, so let me drag the formula. Okay, sorry, I have the formula here now. What's happening? I can drag it until the final year. Yes, that it is. Okay, which means therefore we are going to get back all our money. We're going to get back all our money. By the end of year 2, what you need is 915, 957. That's what the company do need, okay, to get back all the money, okay. By the end of year 3, the company has gotten back even more than what they were looking, the 2 million they were looking for, okay. Because by the end of year 3, the company has been able to obtain a net of 9946, okay. Therefore, the cash flow, the payback, they count this payback of this company. Is therefore gain equal to, okay, 2 years, okay, it is 2 years plus. By the end of year 2, by the end of year 2, what you need is 915,000. Okay, this is what the company you do need. Okay, you do need 915,000. Okay, and that money, okay, is going to be received. Okay, that money is going to be received from what is going to be earned. Okay, from what is going to be earned from year 3. Then by the end of year 2, you need 915. Where do you get that number from? You get it from year the cash flow for year 3. Okay, the 1 million. Okay. And that gives what to give therefore the payback period for the discounted payback period for this company. Okay, to give it therefore, let me check. This is not dollars, so let me remove the dollars. So general, okay. Therefore, again, you have to give me therefore 2.9 years. Okay, 2.9 years will be the payback period, the discounted payback period for this investment. Okay, the discounted payback period for this investment. Okay, and that's how you're meant to apply those 4 different methods. Okay, NPV, IRR, payback period. Okay, both discounted as well as non-discounted, and let's say the return on capital employed. Okay, don't forget there will be a question in your exam also. Okay, there'll be a question in exam also. Okay, in either of those method. Okay, on the appraisal there will be a question. Okay, so you do need to get it very quite clear. Okay, there'll be a question in exam. Question. Any question on what you just done? And by the way, I would propose that you can check on the ACCA website, okay, on the platform, okay, so that you acquaint yourself, okay, you acquaint yourself with the platform, okay, the one you actually find in the main exam, okay, so that you can be able to acclimatize yourself with how it is like, okay. This is similar to Excel, okay? It's Excel itself actually, only that some of the functions have been removed, but at the same time, there's no huge difference, okay? Question? Okay, if there's no question, then I guess we can meet next week on Tuesday. Okay, if there's no question, then we can meet next week on Tuesday. Enjoy your evening. Don't forget to sign, okay, as you exit the class, okay.